Question 6 was a two-part question, and the state did very well in the first part and struggled a little bit with part B. The question said, the owner of Brandt's vending machines is concerned that the business is frequently short of cash and has to draw on its bank overdraft on a regular basis. All purchases and sales are made on credit, and you're given credit terms for your creditors and debtors. What you've got to do is relate that information to a graph, and you're told that the following graph illustrates one factor causing this cash shortage. So there's quite a bit of information to absorb there. Let's look at what's important. First of all, the business is short of cash. It's always using an overdraft to get by. All sales and purchases of stock are made on credit. So in terms of how long it takes to collect debts and also pay them back to creditors, that's really important because everything they do is on credit. And lastly, we're given the terms of credit. So we're given 30 days to pay creditors back, and we allow 30 days for debtors, and we also give a discount if they pay within 14 days. We'll give them 5% off their account. What we want to do is sort of take it back a step and just remember, well, what does debtors turnover measure? So there's a formula, which we don't really need to know here, but that's the formula there. And let's say we plug some numbers in and say average debtors are $9,000. We times that by 365, which is the number of days in a year, and divide it by the amount of credit sales. So let's assume that was $90,000. And let's say we got 37 days there. What would that mean? Well, it means that on average at any one time, the business has $9,000 of debtors, and on average it takes 37 days to collect it. The next lot of $9,000 of debtors, which is the average, will take 37 days, and then 37 days to get the next lot, and so on. So that's the debtors turnover ratio. On average, how long does it take to collect our accounts from debtors? Well, the creditors turnover ratio measures the opposite. So we've given a formula, which again we don't need for this question, but just looking at how it is calculated. We take the average creditors times 365 days divided by the credit sales. So let's pretend we had average creditors of 5,000 and credit sales of 40,000. Now we plug all those numbers in. Let's say we get a creditors turnover of 46 days. What does that mean? It means on average this business has $5,000 of debtors, and it usually takes 46 days on average to pay that full $5,000 back. The next $5,000 of average creditors takes 46 days, and so on. So every time we have an account owing to a creditor, on average we are paying it back within 46 days. So now that we have that knowledge, we can look at the information we've been given, and it is quite complicated in a graph, so why don't we simplify it? Instead of dealing with 10 different numbers, so we can see the debtors turnover there and the creditors turnover, why don't we just focus on the beginning number, which for debtors turnover says in 2011 on average debtors were collected in 34 days. And look at the creditors turnover in 2011. On average we were paying creditors in 36 days. Let's just compare that. Let's skip 2012, 13 and 14 and just compare that to in the 2015 figure. So in 2015 we are now taking 43 days to collect amounts owing from debtors, so that's gone out. We are taking longer, but the time to pay creditors has actually gone down to 26 days. So that's the essential story here. When you look at it that way, it just simplifies it. We know what the ratios mean, and we also know the trend just by looking at the 2011 figure and the 2015 figure. Unless something extraordinary has happened in the meantime, we can ignore those numbers in between.